There it is. Okay. Welcome, everybody. Tim Quast, and I'm in like 4 layers because it was freezing cold in here. We came in, I've lit you could, I don't know if you can see it. There's a fireplace in this room behind me, and I've lit the pilot, and everything was cold. So it's warming back up in here. 60 degrees isn't that cold, but that's what it was when I walked in here. Anyway, so this is the December 8th Edge demo, and maybe demo isn't the great description because we really focus in on how to use it practically. That's the aim here, and the Edge is predicated on understanding how the stock market works. And I'm going to take it. That's point number one. I just want to talk about that a little bit because most people don't know. This board of directors that I was addressing, one of my colleagues, one of the client services team members, was with me, and a couple of guys from the GTS floor. They're a designated market maker on the floor that makes a market in this particular stock. That's a whole separate discussion. They were there. Market intelligence guy was there, and so we addressed the board. I'm going to share this with you. I won't belabor it, but there are just five slides in here. But I think that this is helpful to understand how the stock market works and why. And then we'll get into some important, the Evergy, I want to talk about that and similar examples. But this is, so if you're new to Market Structure Edge, it is predicated uniquely. There is not another tool like this. We have some institutions like State Street beginning to use these data to help them think about supply and demand when they're rebalancing portfolios. And it's new to them. People don't tend to think about these sorts of things. There are some that do, but most folks don't think about how does the market work. And this is a great beginning point. This is what I did in my section for the board. I said, so it's important to understand that the stock market is a grocery store. It is a store with consumers. And those consumers have demographics that are measurable, just like the consumers, it's a gas utility. You know what your consumer demographics are, what part's commercial and what part's residential, and true for any market. And the data for a market or an ecosystem will tend to show you what the purpose is. What's the principal purpose? Let me go back here and make sure I've got everybody in. And I won't, if I've missed you, I will a question, I will make sure that I get to it. Okay, there we go. And so you could look at this data from the year 2000, but it would be true. This is the US stock market, which, by the way, is not in downtown New York City. That is the faceplate for the NYSE, and there's a faceplate for NASDAQ in Times Square. But the stock market is really in New Jersey on big servers in Mahwah and Secaucus and Carteret, New Jersey. I have not shared my screen, have I? Thank you for that note, because I would not have realized that I wasn't doing it. So let me share my screen, and I'll go through these and with dispatch. Okay, so this is it. Here's what I showed. Just for the moment, look only at the left. And this is a way we use this approach for public companies oftentimes because they don't think about this. All public companies suppose that the stock market is a place where equity investors are matched with equity investment opportunities in the US market. And that's part of it. But and for a long time, it was the world's very best at that. From 1792, which is when the roots of the NYSE began with 24 brokers, to about 200 years, the market had a central purpose of active stock picking, where fundamental factors, revenues minus expenses equals cash flow and earnings was the core driver. And this was true behind the volume in the S&P 500. In 2000, this was, it's not exact, but it's a pretty good model. About 80% of market volume came from stock picking. And, there were other things. There are always speculators. If speculation is more than 15% of the trading volume or the volume in any market, it's probably telling you that the principal purpose is becoming inefficient. And then you have insurance. So, there's portfolio insurance just like there is for your house. You protect your house against fire and flood and theft, and your life against death. The stock market has insurance too. Big institutions will insure against the unknown with derivatives and things like that. Let me just, I think somebody's knocking here. Let me go back over here. All right, there we go. And so then step forward to 2022, this year. This is the demographic composition of the S&P 500, 200-day average. And so you look at this and say, well, what is the principal purpose of the stock market now? Well, certainly not active investment anymore because only 10% of trading volume comes from stock picking. Shocking, right? You think, well, all day long on CNBC, they're talking, stock pickers are talking. Yeah, well, they're talking on TV instead of doing stuff because the market is 75% of trading volume comes from machines chasing prices and money following models that are characteristics. I say price and characteristics are the principal purpose of the market now, which is why we do what we do. Once we understand that a lot of the volume comes from setting price, you don't want to be fooled by price. That's why we don't trade price. We trade supply demand divergences. Far more reliable. Prices will fool you because these machines are in and out in a day. Most high speed traders don't own anything at the end of the day. And I'll keep it simple here. That is what you have to know. And you would say, well, what kind of money do those behaviors represent? It's not really how we think about it. We use what are called 605 and 606 data that exchanges sell. We run those through our software and mathematical models and algorithms to understand the purpose. The rules govern the purpose. So if a trade is executed a particular way, it will be different if its purpose is setting a price versus the kind of money that is trying to get a bunch of size in a stock. They behave differently, and we use models to understand that. In Edge, you will see the key behavior. That is what it's telling you. You say, well, wouldn't it be nice to know? You don't need to know all this. I'm telling you, because we've been doing it a long time. We make it, so there was more complicated information in some ways for public companies because their purpose is different. They're not trading. They want to know what is helping or harming shareholder value. For a board, the board is the fiduciaries for shareholder assets. They need to know what part is about our story. How are we being used by indexes and exchange traded funds? Are people speculating on our stock? How do they bet before or after earnings? All of that is measurable. And that's how they use our data. But you'd say, well, T. Rowe Price is a great example of active investment. And that happens to be this company's largest long-only, conventional investor. Passive investment would be like BlackRock, Vanguard, State Street. Global macro hedge funds like AQR and Bridgewater. Fast trading, these are the machines. They don't have customers. Proprietary traders like Jane Street or Citadel or Virtu or Quant Lab. TradeBot, to me, I didn't create the slide. I would have put somebody else like Hudson River Trading or Infinium or Tower Research or Susquehanna. But those are machines that set most prices. Why? Because that's the rule structure. It is a time priority market, meaning the fastest price gets to price the whole market. And these guys put their servers right in Mahwah, Carteret, and Secaucus, right next to the exchange servers, right next to Goldman Sachs' servers. And they can go back and forth in between, and they're always ahead. And they have better data. Well, you can't beat them, but you can follow them. Right? That's what we use. That's why we use supply and demand, so we can understand where's the money going, and let's go there. And that's how it works. I just want to keep this moving. And here's something to know. So all of these behaviors have to pass through what we call the Death Star. We didn't come up with this, by the way. The person who came up with this is Met Kinak, who's the global head of electronic trading for T. Rowe Price. T. Rowe Price is a they're a conventional 40 Act investor who buys and sells long positions in stocks and manages large institutional positions. And he did this for public companies so that they said, well, why aren't you buying our stock? And he said, because it's impossible. If here's a buyer, you don't have to understand all the details, but it's an important lesson on the stock market. There's a buyer on the left and a seller on the right. The definition of a market, by the way, is aggregating buyers and sellers. If you want to buy Lululemon products, you go where those products are aggregated at a Lululemon store. And then consumers of those products know they can go to the Lululemon store and find many of the products. Well, the stock market now has this vast intermediating web of things that push buyers and sellers apart from each other. And so this process becomes an end unto itself. And I like it as this is what happens. There's a buyer, an investor, who then has to go through a broker dealer who will use algorithms. They're just tools. I could reach in a toolbox and use a Phillips screwdriver or a flathead screwdriver, or in the kitchen, a chopping knife or a paring knife. Algorithms are the same. They're just a tool and means to an end. But those tools will go through order management and execution management systems and out into the market that is ringed by what are called dark pools, broker-operated markets. Goldman Sachs and UBS operate the two largest in the market. There are 32 of them. You can find out all of this data. Go to ats.finra.org. They track all that data. You can see it. And so you can liken it this way. On the way to Nordstrom, where you want to buy, let's say, shoes, socks, and pants, which is the stock market, let's say, you're walking and people pop out of alleys and say, I'll sell you a shoe or a sock or a pant leg for less than you will pay at Nordstrom. That's what's happening. By the way, if I see one of my trades execute at the NYSE in a retail liquidity program or at the NASDAQ, I know I'm getting now the worst prices, and I'm going to stop and I may sell the position because I know now that all of the efficiency, the better prices have been consumed. And I can see whether my trades execute in the dark. If they do, I'm probably good and I may continue to add. If my broker takes the other side of the trade, you can pay a commission at Interactive Brokers and see these things. Then I know that the broker was forced to buy my market order because that's the law, and they couldn't find anybody with a better price. Well, that might not be best, right? It may have an impact on whether I continue to buy something and ship to selling. We'll talk more about that. So I said, this is what the stock market is like. It's why people struggle to buy or sell your stock. And this is what it looks like for you. The reason you have such a large part, it's hard to read this, but the orange part is fast trading. And so you would notice the red part, active investment, is the same for this stock as it is for its gas utilities peers and for the S&P 500. There's nothing wrong with their story, but they have half as much passive investment and a lot more fast trading because they're small, and passive money wants size. It's why the Dow Jones Industrial Average outperforms the NASDAQ over the past 22 years, because passive money wants size, not growth stocks. And so the Dow outperforms the NASDAQ. Well, these are just things that everybody should understand about the way that the market works. Okay, so this is the last thing we showed how this is fast trading as a percentage of your trading volume over the last 5 years, roughly, and sometimes it's 80% of your trading. And this has moved opposite the size of the trade. Your trade size has continually come down because the machines fragment trades. Again, this is why I often trade in very small increments. Once you understand the rules, then you can use the rules to best effect so that you can execute trades better. You can understand what's going on, what motivates the money. It's not all motivated by the same thing. It doesn't have the same purpose or time horizon, and that's very important to understand. Okay, I thought that might be helpful to you. So let me go back over here and I think somebody was coming there. Juan's having some struggles. Okay, let me look quickly at chat, and then I've got plenty of other things here. I'm going to show how to use your platform. Okay, yes, I am, Pam. Okay, yeah, that's the thing. I try to do this in 30 to 35 minutes, and there'll be only so much I can cover. Let me get to the platform. And so here it is. And by the way, there are a dozen short videos that are just, I'm very happy with them. There's nothing's perfect, but I was happy with how these worked. And if you go to Pam, I'm doing this for you, just so you've got a point of reference here. If we go to this is the homepage for Market Structure Edge, marketstructureedge.com, go to resource, how to use Edge. So if you click there, these are all very short videos, and they go through everything that I talk about all the time. I did them, right? So, how cutting to the chase, how to use it with Apple. And I won't go all the way through that, but they're short and they're very useful. But the whole point of Edge is, what is the broad market doing? Are there things on the cadence or calendar of the market we should know? And then let's find supply-demand divergences, BCD. So what's the broad market doing? I do this every day. I'm going to go look at what's the broad market doing. Well, demand, that's this algorithm, the green part that is taking those demographics of the market and looking at investing and trading, and is there increasing or decreasing demand? And it's a mathematical model. It works beautifully. It's not perfect, but it always tells us what the propensity of the market will be. And as that level gets very above the red line, the probability that the market continues to rise consistently drops to near zero. And notice that the market is almost where it was when we taught that red line. It may fluctuate some. There's a lot of volatility in the market, but we know that the broad market probably has less upside. So maybe you now shift. If you all that time where broad sentiment is rising, maybe you have more exposure to, let's say, SPY, which we use for price here. And then when it tops this red line, now maybe I'm going to shift to being more tactical. I use it tactically anyway, but this will help me to know now my time frame shrink, and I'm going to be very careful about taking gains whenever the opportunity presents itself. Supply is short volume, not short interest. That's a 1974 measure. It does not apply to the US equity market. Now, this is a 2010 measure, and it is borrowed stock. The market depends on it. It's the supply chain of the market. And when that begins to rise and demand flattens out, the ability of the market to continue to post gains will diminish. The market's, until today, the market's down 4% over the last week. It came off of the highs, and it's very understandable. It's not about the Fed or economic policies per se. All of those are inputs, but they're going to show up here. Whatever people think will show up in supply and demand, and we'll know what merit they have. So then the last piece of the puzzle is divergences. And there are momentum things that are likely to rise faster than the broad market with better predictive capability. I like those. And there are things that are stable. And so when the market begins to become like this, where I can see supply is rising and demand is flattening out, well, I'm going to go look for some big and stable stuff because I know that money, big institutional money, will do the same thing. It's going to say, ooh, we're concerned about volatility. Let's go to low volatility things. Well, just look at this. Here's demand right at 5 most of the time and supply falling. There's only one in this. That isn't good, by the way. This tells me the market is not properly hedged. It is not prepared. If we have a period of volatility, people are going to get hurt, and it will compound the downside. And again, I'm not saying that'll happen. We just follow the data. But this is why I bought Evergy, and I bought a lot of it, because I looked at that and said, well, I mean, the mathematical probability that big and stable is a good place to be is very high. And so it's been, and I don't have to leave yet. I could look at it and say, well, look at this. Day over day, supply continues to fall. Demand is very good. Price is rising. I'm not looking for a lot of gain. I'm just continue to have a lot of exposure to something that is likely to do better than other things. And it's been very true. Right? And the math will tell you. You don't even have to hunt around. Just use what the math shows you. The other side of the coin will be momentum, whatever you want to call it. I have these experimental portfolios that I think I'm confident enough now with that math to make these momentum. I won't change the name. We'll just, we've got momentum and volatile tens. I'd like to get that down to just one. You have big and stable, you have momentum. And generally, those are going to help you. If you're good enough to short, I hope to have a little time to talk about that too. I get notes from you guys all the time about why aren't you doing that? Because if you could capture moves both directions, you can double your returns. I haven't had enough time to become good at that. But if you look at momentum, the more there are, the more that the market is telling us that those opportunities exist. 2 days ago, there were 15 of them. Now we're down to 3. Well, now the math is telling us those opportunities are diminishing. And I don't love any of these. Workday is the best one, and I'll show you how I look at this. So first, look at the volatility. That's telling you how much these stocks move between intraday high and low prices daily on average. It will fluctuate, but there's a lot of it. So if you look at broad market sentiment or broad market supply and demand, they look good. Context, there are no options expiring. It's early in the month, and then you look at divergences and say Crocs. It's not I don't love this, so it's just an example. But if Crocs is down 3 or 4%, and I know that supply and demand are diverging, well, I'm buying that. Because now I know mathematically how much I should expect it to move. And if it's down 3 or 4%, the probability in the next 2 days that I get some of that is pretty good. So then if it rises 3, 4, 5%, then I take that gain and go look for the next opportunity. Here's what I don't love about Crocs. So it's got rising demand, but the supply is also beginning to tick up. Well, that's suboptimal. As James, as a Brit would say, it's suboptimal, right? So that's so. But and then I look at Workday. Why is Workday a better choice than Crocs? Well, in addition to the fact that it's more liquid, $9,000 a trade versus $5,000, it has better supply-demand divergence. It's not awesome either. I would like to see this really drop off, but there's a probability of producing a pretty good return there. Again, you would look for some part of 3.5% in a short period of time. In conditions like this, 2, 3, 4. Different with Evergy. I'll hold that as long as the conditions continue to warrant it, because it's big and stable. For momentum, I'm going to be very quick to take those gains because it goes up and down, right? And if it's down and there's the supply demand divergence, there's a high probability in the next 2 days it goes up and I take the gain and go look for the next one. That's really the key to producing good returns. It's what fast traders do. It's what all the rich people, Ken Griffin does. They're experts at this. That's what they're doing. And so it's good to know. Okay. Let me go to 2 other things. I've got Hal keyed up here, and then I'll take questions. We'll talk about everything we can. So I mentioned in the market desk note, am I too soon in Halliburton in the energy group? I mean, I think that I'm looking for inputs. When the behaviors say, well, energies could be good to trade again, it hasn't been for a little bit, frankly. Will it manifest here? And I bought it. And do I look at this and say, well, is this awesome? Well, no, it's not, right? And I'm down $400 in this. And I have a lot of it. So, demand has peaked and signals that it's probably about to decline. Clearly, price has fallen, but I bought that drop. And while supply is falling, it's well over trend. These are very low levels. I'm not particularly concerned. And a weakening dollar tends to boost oil. You just don't know how long those gaps will be. So I may have to just sell it. But that's how I think about the data, right? What's this data telling me? It could give me a gain, but it might not, right? It's clearly not awesome. It's not when you would buy it. This is not, you don't want to buy falling demand.
Tim?
Yes, James.
Sorry, can I just on Hal, can I ask you something?
Yes.
I'm with you, and I did the trade at the same time as you, and in hindsight, I'd still have done the same trade. And
Me too. Yeah.
And I'm still in the trade.
I am too.
Well, not this morning, but yesterday morning, apart from the data, somebody upgraded it or downgraded it. One broker upgraded it and one downgraded it at the same time on the same day. Okay, so that must have an influence. I know you're going to say, no, just stick to the math. Okay.
Yep.
But if I found out about that after I'd put the trade on, because I wasn't looking.
Yep.
But if you would have had that information of the one upgrade and one downgrade before you put the trade on, when I did, would you still have done the trade?
Yes. I bring my own biases. Everybody brings confirmation biases to whatever they're talking about. And I have mine because I've spent my entire profession, my whole adult life in the investor relations, the U.S. equity capital markets. And I know the buy side and sell side very well. And the whole, upgrade, downgrade, the whole racket that is the sell side. And the sell side has really lost influence. And I won't pull it, but I think this is an important note. Prior to 2000, this is why the market changes. What happened in 2001? Decimalization. The government inserted itself into the relationship that the sell side, the Morgan Stanleys and Goldman Sachses of the world had with their customers. and said, you're charging too much. Well, that spread between the bid and the offer lengthened horizons and financed research coverage, strong aftermarket support, secondary market trading by many firms. And that went away. And it's even worse after Reg MS. And the sell side is basically an artifice now. No offense to them. But I know hedge funds don't pay any attention. If anything, it might give me an entry point. So
Right.
I do care about earnings. I do care about earnings. I do care about options expirations. I don't want to get caught by earnings. I make sure that there isn't an earnings date coming right up in something that I'm about to buy or sell. But upgrades and downgrades, I ignore them. Doesn't mean you should. I just do. I
Thank
don't.
you.
Yep. I want to mention BEKE too. This is a highly speculative stock. And I bought a little of it knowing it's speculative, right? Knowing, look, I might have to just throw in the towel. I only bought a little bit of it. But I did it because demand rose and supply plunged. And it moves like almost 10% intraday. Doesn't mean it will on every day. But I thought, I might do that. Again, I might have to throw in the towel on it, but I would. This math is good. It's just that it's a very volatile stock. It's a Chinese ADR, American Depository Receipt. They're heavily arbitraged vehicles. There's an additional cost. It's not a great thing to trade. But I did it as this is my speculative trade. What if it goes up 8 or 9 or 10%? I bought the steep decline. I bought it down 7, right? So I thought, well, I might. But that's how you should think about that. What are the things working to our advantage? Very strong demand, weak supply, nothing going on that's going to affect the outcome. It's not about to report earnings. And there are things going on in China that might benefit it. I don't pay a lot of attention to that, but I read things. So that's, again, this is the divergence. Pam, this is the way to use the platform. Now, if you short, you could do the reverse. I have not studied it. I'm the kind of person who likes to aim small, miss small. Let me learn this, try it, experiment with it, have experience shape what I know, and I haven't had a chance with that. But I do run short portfolios just to say, well, the math should be the reverse. If momentum is diverging supply and demand that's very strong, then shorting would be the reverse of that, right? And so I run, here's a short and short two. Look at how that, I have 58 companies in the short two portfolio. Well, it tells us the bias in the market is shifting short. That's what it's doing. But I don't have the time to think through it. But there you have it, Pam. Long divergences, liquid stocks, know what the volatility is, know what's occurring, what's the big money doing, the broad sentiment. And then if you were doing the reverse, then it's the exact opposite. If diverging supply lifts price, converging supply and demand hurt prices. It's not axiomatic, but it's very reliable and it's very simple. You only have to know 2 things, supply and demand. And so that's what we aim to do. Okay, I didn't cover everything, but I want to make sure I answer questions here. And no, we're just about out of time. So I will answer everything I can. Okay, I'll say trading since 2000. Good for you. You've been trading futures for a living. Okay, well, that's very good. That's what we're capturing in risk management, by the way. And that category has exploded. So, month-end futures contracts, we have that on here on broad sentiment. These little squares, that's futures expirations. They're huge now because the SIBO created, you probably know all this. They created this instrument in 2014 to help passives track the benchmark. Passives like to use baskets of futures to true up their tracking. They're not trying to pick stocks, as you know. They're trying to track a measure. Well, I watched that stuff, and clearly insurers got clocked this time. They had to buy stuff to make people whole, and look what the market did with futures expirations. Whenever you see these 3 together, or like 2 and then 1, those are monthly options expirations. We track those too because they're so often turning points. Market fell apart here, recovered here, flattened out here, jumped here, but we know that's insurance, so it's not likely to sustain the market. Sure enough, the market is right back where it was before those futures expired. I pay a lot of attention to that stuff. I want to know what supply and demand are into those events because they tell us which is the bias. They're buyers and sellers of volatility. and somebody gets paid a premium and somebody hopes they don't have to use the policy, right? Okay. What else we got? Yes,
Tim,
triple, yes. Mhm.
Just a quick one. Can you
You bet.
do a video sometime on your volatility strategy? That would be really useful.
Barry, I admit I was reading something right then. I was reading the, say that again.
Oh,
I can
yeah,
barely do 80% of one thing at a time. So,
yeah, no problem. You're a busy guy for sure.
and not
Hey,
that smart. So that's the other, that's the other issue.
I beg to differ. You are a smart guy. Hey, could you do a video that explains how you utilize your strategy with volatility? That'd be a
Yep.
useful
Yeah,
how-to video. So it's
sure.
just whenever you get a chance to, but that'd be useful.
Absolutely. And Corey, you asked about should it be used in conjunction with any options plays? Well, absolutely, you could do that. Yes. So particularly if you understand the time decay feature, I forget what the Greek is for that. You will know perhaps better than me. But if you wanted to, let's go look at Workday as an example. If Workday has options that expire next week, let's say, so fairly well time decayed, and you see this kind of supply demand divergence, it depends on what you want to do. Do you want to buy volatility or do you want to sell it? Under these conditions, generally, you could probably sell a put, right? And you probably keep that premium. You could buy calls because the calls are likely to appreciate. It's not perfect. We're getting late in the cycle. I always get a little concerned with broad sentiment has rising supply and flattening demand, that it's going to hit the work days of the world. But that's how of course, you could do that. And it should absolutely inform what you do with your option strategies. You do not want to be buying calls that you hope to sell to somebody else for a higher price if demand is falling and supply is rising, because price is going to go down, all other things being equal. So, yeah.
Hey, Tim, follow-up question on that.
Yeah.
So, and I've watched a lot of your videos and caught you on Benzinga, so I've seen you, go through your tool and stuff. So a lot of times on Benzinga and in your emails, on your calls, you're focusing on stuff that has a market sentiment at 5 or greater with a falling, supply, right?
Yes. Yep.
But in studying, past examples, I guess, is it maybe sometimes better to look at stuff that has like a market sentiment of 2, maybe 3, that has short volume? Because sometimes it seems like when I'm looking at some of these that I'm a day or 2 behind on catching the upside, and then once it's hitting the 5-6 range, a lot of that upside's already gone. So
well, it's a great observation and a great question. And what we have found, I've got young Nate, the mathematician, crunching data all the time. I will give him parameters and say, let's find out what the probability is that this produces a return versus that. And and I started out the same way. In fact, I'll use this company that I just spoke to the board. If you look at where supply bottoms, that's where you would want to buy. Right? You could look at this and say, well, here's where they got clocked with earnings. Look at that huge short bet beforehand. You could see it coming. Then everybody covered. Well, it's only a 1, but this was clearly the point where you would want to buy it. So there are always exceptions. I always focus on the central tendency, the highest probability. I mean, how much did you miss if you waited for it to rise above 5? Not a lot, but there is some. That's the risk. What is the risk of buying something at 1 that it never gets back above 5?
Right.
And look, I've done that. Okay, early on, I thought, oh well, I'll just buy a 1 and sell it at 10, and we found that was not as statistically reliable as diverging supply and demand with strong demand. It doesn't mean it doesn't work. And I think it could work very well with options. It could. You could go screen for things that have a sudden drop on the supply side that are at 1. And maybe those are the things that you want to buy calls on, because then the price starts moving, and then you sell the call right away to somebody else, right? You're trying to, buy low, sell high.
Yeah.
But that could be worth doing. And you can do that with just create a dynamic portfolio that will look for those criteria. And I'm happy to help you do that. I'm going to have to let you guys go pretty soon. I thought I'd go a little longer because I was late.
Thank you.
You got
Thank
it. Yeah. Absolutely. You're right. It's just there's a little more risk is all. Yeah. Okay. Last question. What's our last question? You got it, Pam. Did I miss something up in here? Let's see. Okay. I didn't even look, Pam. Did Workday move? The math is more reliable than anything else. It's not perfect. It's like Winston Churchill said of democracy. It's the worst form of government in the world, except for all the others. And that's kind of how it is sometimes. Okay. Are we good? Then we'll do this again next week, and come back and ask good and hard questions, and I will come prepared to give you whatever I possibly can. But it's always good to see you. James, good to see you. Barry, Pam, thanks for the questions. Corey, just drop me an email if you need some more input on that. Okay, guys, have a good weekend. We're headed to we're back in Steve. We got music and dinner and all kinds of things happening up here. So I'm gonna go see the lead singer of the Drive-By Truckers. That's what we're gonna go see tonight with some friends. I'll report in. See ya.